Okay, good morning, everyone. I hope you guys are having a great Tuesday. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're here to take a look at the markets as we do every single week here for everyone here at Firstrade. Looks like we are starting our morning off again on a positive note after a very strong day yesterday on the backs of optimism that the coronavirus is being contained within countries in Europe and also here in the US. The one thing I will say is that based on the data we're currently seeing, it certainly seems like the data has flattened a little bit. However, 1 or 2 days do not make a trend. So we are monitoring this very, very closely. But if the number of cases and the number of deaths have peaked this weekend, then that certainly is a very good outlook for the markets from the perspective of the duration of this is what's most sensitive to the economic impact. And the earlier we peak, the less the duration of the economic impact we expect. So what we want to do is we want to show you some of the research we're currently looking at, where we currently stand, and provide some themes that we currently see in the markets. So let's go ahead and get started here. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a recommendation or solicitation to buy or sell any specific securities. So the current market outlook is, right now, the S&P is still within what we would consider a fairly range-bound area, because what we had is the initial sell-off from that 339 high all the way down to the 218 low. We bounced up to the 20-day moving average, had a tough time with that 20-day moving average, bounced lower, and now we've broken back above that 20-day moving average after over the weekend, when it looked like the number of deaths here in the U.S. may have peaked. We had the second day in a row yesterday where it did not exceed that peak, which is good, and I think that's why we're seeing the markets up another almost 3% pre-market. Now, prior to this rally, we've identified the 273 was a major resistance level and 235 was a major support level on the S&P. So right now, we're just about to open up shy of that 273 level. We actually touched that 273. It even exceeded a little bit over the night. So far, we're still below that 273. We do expect a fair amount of resistance here at 273, a fair amount of selling at that level, predominantly from investors that have bought during the first couple of dips as the markets rallied. These investors are stuck up here with losing positions, and we anticipate that when the markets do trade into those levels, that you would have selling because you have investors that are trying to get out of their positions at even above. So we do anticipate 273 to be a fair amount of resistance here. Until it breaks above 273, my expectation is that the market will trade sideways in this area. And I will say that not a lot has changed on the economic impact front since Friday, despite the fact the market has rallied almost 10% since that level. So I want to take a look at some of the research here, but right now our views are the S&P are still going to remain range bound. Even if the coronavirus did peak this weekend, we still have to look at the economic damage, which at this point is still very, very broad. Certainly worse than what we had expected even a couple of weeks ago. So right now, our expectations for the rebound and the recovery is going to be pushed out into late 2020 and into early 2021. The one thing that has changed a bit since last week is the fact that oil has recovered a little bit. Crude is trading around $26, Brent around 33 right now. So they seem to have bottomed at this point, but this is going to cause a lot of problems for the energy industry because most companies are not profitable with oil at 26 bucks. They simply cannot pump oil out of the ground and make money. They're literally losing money to pump oil out of the ground. That is going to continue to be a sector that we're going to pay attention to but also at this point likely avoid. So oil is certainly one factor that we're looking at. If oil can rebound into the 30s, 35s, then I think we will have a little bit more legs in terms of looking at some energy companies. And lastly, risk on, risk off. So if we look at the VIX term structure, the 3-month VIX right now is still below the front month, 1-month VIX. But as you can see, those two are converging. They're about 1 point apart. 44 on the front month, 43 on the 3-month VIX. When the front month falls below the 3-month VIX, that's when we would say that we are in more of a risk on mode rather than right now still a bit of a risk off mode. But we're just at that tipping point right now between risk on and risk off, just like how we are just at the tipping point of 273. So it's important to see how markets react to this point. If we can strongly rally above it, then that would certainly be a very good sign of more of a risk-on market. Until it breaks above 273, I'm more inclined to sell premium above 273, sell credit spreads, because, again, I believe that this market is going to be more range-bound as long as we stay below 273. So those are the levels we're currently watching for today. Some positive news on the coronavirus. Spain seemed to have peaked here at the beginning of April. They've had consistently 5 days of declines in new deaths. New York and in the United States, we had our peak so far over the weekend. We've had 2 days, Sunday and Monday, of number of deaths below that peak. And the question is to see if today it's going to stay below that peak or if we're going to move higher. That is, I think, a very sensitive data point to keep an eye out for this market. And because if this market peaks again, if we get another peak that's above that 1300 peak, then I think markets will continue to sell off again. But if we have another day where it stays below that peak, I think we will at least I would say that the likelihood of revisiting that 235 low decreases if we continue to see decreases in the number of new deaths. So that's some positive news coming out of this. I will say that a peak here around April 4th is a little earlier than most models were showing, which is, again, part of why the markets are currently rallying. I want to take a look at some of the economic impact of some of the things that we're seeing or some of the research that we're looking at. So first and foremost, some of the positive news. The Fed stepping in with monetary and fiscal policy, in terms of monetary policy, both in terms of reducing the overnight rates and also the operations that they have completed in the fixed income markets, we're starting to see some of the positive results of that. The 10-year yield is back up to about 78 basis points. We're seeing some of the junk rated bonds in terms of companies being able to issue some bonds over the last couple of days, and that certainly means that liquidity is certainly coming back. A lot of the issues that caused the panic sell-off, that seems to be evaporating at the current moment. If we look at options liquidity, that also is improving. Yesterday was actually, and I'll show you that in a couple of minutes. Yesterday was actually the first day that we saw an increase in options liquidity over the past 4 or 5 trading days, which again is also a net positive, and I expect to see that continue to improve today. Which means that we can start to look at specific sectors and specific symbols to start trading as opposed to trading the broader market combined. If we look at credit card spend, and that's the data that I have here on the bottom, we looked at this data last week, but we now have updated data up until the end of March. As you can see, just if you look at the overall spend, we kind of declined here at the end of March to about almost negative 40% on the year over year in terms of spend. That eased a little bit towards the end of March. So let's see if that trend continues. If that is the case, then perhaps this time frame was really kind of this time frame was really kind of when things took the biggest dive, and then hopefully things start to recover going forward. But again, this is really 1 day's worth of data, so not quite enough to make a trend. But some of the things to look out for, yeah, I don't think it's a surprise that these types of airlines, travel, restaurants, and transit stocks, categories are the ones that have seen the largest decline. What is encouraging is the fact that online electronics and grocery actually is continuing to remain strong across the board. Clothing and furniture is pretty consistent in the 50 to 60% decline. So those are some of the themes that we're paying attention to because a lot of clothing companies have not seen the type of declines that we're expecting. So perhaps those are some of the names that will see some surprises during earnings season to the downside. But if you look at home improvement, retail, home and beauty, those are some of the actual relatively strong names. They haven't seen as big of a decline in spend as some of the other categories. So those are some of the places that we're going to see. Also, total online retail still positive on the year over year. So there are a lot of industries that I would say that are worth starting to take a look at going into earnings season, which is kicking off, in about a week or so, where we're going to start seeing some of the quantitative data about how we expect earnings seasons to play out. And Aaron asked a really great question. How can percentage be actually negative, meaning negative 104? And I believe, Aaron, the answer is actually due to refunds, meaning someone who had spent something in previous months and actually getting a refund for it. So not only are you declining in terms of, not only are these airlines losing money, they are actually having to issue refunds. So that's how I think you have some categories that are in the negative one or categories below 100%. So interesting data points to take a look at. And what this shows us is that there is a bit of disparity here in terms of spending shifting away from some of these industries of travel and leisure and restaurants and transit into other categories: online electronics, online retail, home improvement. So those are some of the sectors and stocks that we want to pay attention to going into earnings. So some of these sectors and themes that I want to point out to you guys here. First of all, semiconductors. This is one of the strongest sectors right now in the market. And this is one of the few industries where we expect a fairly quick recovery than pretty much most other industries. So let's take a look at some of the names here. AMD, one of the strongest names in the semiconductor space, trading back up to that 47.5 level, even though touching into the 37s last week. So we've seen quite a rebound. It's trading back near its February and almost back to its February highs. So this is a sector that we're certainly paying attention to. Names like AMD and Intel, I think, are the names that are breakouts here in this particular sector. As you can see, call options are pretty expensive here on these particular names because they are the strongest. So, if you're interested in these particular sectors, be careful. I would certainly look at using spreads whenever possible to try to offset the cost of the high implied volatility. But this is certainly one of the strongest sectors. They do report earnings fairly soon, and these are the sectors that you might see some strength going into the next couple of weeks. Commercial aerospace. This is also another sector that I think it's worthwhile taking a look at. We've been getting a lot of questions regarding Boeing and even some of the airlines asking if it's time to start thinking about buying these sectors and these specific stocks. So the data that we're currently seeing, number one, there's been a 95% decline in traffic. This is one of the industries that we expect one of the slowest recovery periods for the market, because for the aerospace companies, we're already starting to see canceled orders. I think this is a space that's similar to the I would say the automobile space, from the perspective of not only are the makers of planes like Boeing, Airbus, Bombardier struggling in terms of in terms of fulfilling their orders, but also their suppliers that have completely ground to a halt are going to have some trouble getting back on their feet. So General Dynamics, Textron, Air Lease, these are all companies that we think over the next 2020, 2021, and even going into 2022 will really have will have a lot of stumbles getting back on their feet. So this is a space that we think that it's still a little too early to get into. The decline in traffic, 95% decline. This number is still increasing. Corporate travel is pretty much zero at the moment. Commercial travel is actually still declining at the moment. So until we see a meaningful uptick in commercial traffic, meaning leisure travel, we don't think that it's a good time to get into some of these names just yet, especially some of the airlines. We're still looking at the airlines in terms of what type of bailout these airlines are going to be they'll be having. And we are at this point segmenting between the legacy airlines versus the domestic discount airlines. My hunch is that the domestic domestic discount airlines may likely get back on their feet a little quicker than the legacy international airlines. But again, very early to tell. We're still seeing decline in traffic. So until that picks up, we don't think that that's a space to necessarily venture into just yet. A bright spot is actually the discount retailers. And the discount retailers so far, like Dollar General, have been doing quite well, mostly on the back of people buying and stocking up going into the lockdown period. People needed to buy toilet paper, buy groceries, as we saw on the credit card data. Those are sectors that people have been buying very heavily. Dollar General also investing fairly heavily in a digital strategy to allow people to pick up without having to necessarily go into the store, breaking out to a new 52-week high yesterday. One of the only stocks in the S&P 500 breaking out to new 52-week highs. So breaking out above that 165 level, I think, is a pretty significant move here for Dollar General. And a lot of these names like Airlines are very sensitive to tax refund season. And the fact that you have stimulus coming down the line, these are tailwinds for most of these names. Another interesting group to take a look at is actually the auto parts retailers. AutoZone, Advanced Auto Parts, Genuine Parts. These are stocks that, as the auto industry comes grinding to a halt, as we head into a recession, people are less likely to go out there and buy a shiny new car. They're much more likely to repair and keep their old cars. So a lot of the discount, or rather the auto retailer stocks, those are ones that are actually going to do relatively well. So AutoZone, AZO is also one of the stronger stocks. As you can see, it's not down as far from its peak as most of the other stocks. Advanced Auto Parts, same thing. These are stocks that we think, have kind of created this a bit of a bottom here. And I think you can look at perhaps some bullish opportunities going into some of these stocks. The stock is up 13% yesterday. Clearly one of the outperformers versus the market up about 6% yesterday. So we expect this type of strength to continue in some of these auto parts companies as car production kind of grinds to a halt. Media and streaming, Viacom, Disney, Discovery. We've been getting a lot of questions about whether, it's a good time to start buying Disney. A lot of people are interested in Disney, being the fact that, you might see that Disney Plus is doing fairly well. They're about to launch in Asia and India. So there's a lot of optimism for this stock, and the stock's up about 5% yesterday. But our research for these stocks showed that there's been a very steep ad revenue decline in these particular names. And we think that this ad revenue decline is going to actually stay for quite some time. So the outlook on these stocks actually have dimmed a bit over the last couple of weeks. And with the production of new content at a complete standstill, these companies are going to have a little bit of time to get back up to speed and producing new content. So for these reasons, we think that these names are going to actually underperform the market as the market recovers. So for those of you that are asking whether it's time to venture into some of these names, we think that at the moment, it's still a little early. And lastly, home improvement. Home improvement, very strong revenue throughout the lockdown. As you saw through some of the credit card data, we've seen almost no decline, just a little bit of decline in the home improvement space. Maybe just a lot of people at home while they're stuck at home trying to buy some home improvement and improve their house. They never had the time to work on their house projects, so they're doing so right now. So Lowe's and Home Depot, right now, at least for this particular quarter, we think are going to see some pretty strong results. Lowe's trading now at $35, down up 9% yesterday when the markets are up 6%, showing some pretty good strength here. We think that heading into earnings, which comes up in just a few weeks, these are stocks that are likely going to perform. I've always consistently liked Home Depot a little bit more than Lowe's, but I will say, given this current environment, I think Lowe's sold off a little more heavily than Home Depot, so I think there's perhaps a little bit more opportunity in Lowe's than in Home Depot. Normally, in normal times, I think I would prefer Home Depot over Lowe's. So those are some of the names that we're currently paying attention to in this market, both from the questions that we get from our customers in terms of whether we think it's time to get into it, and symbols that we're looking at. And lastly, what I'll do is I'll end with the liquidity list. So like I said, liquidity for the first time improved in quite a few trading days because we peaked last Tuesday at about 130 names. And then things actually got a little bit worse as the market sold off into last Friday. But yesterday, we saw an improvement here, about 133 liquid symbols. This list is organized by liquidity. So the most liquid symbols at top, least liquid symbols at the bottom. And we tell you whether it's very liquid, somewhat liquid. We tell you the implied volatility rank for those of you that like to look at that type of data. And then we show you the earnings date. We see a lot of stocks that have earnings coming up. You can focus on those names. If you like to trade earnings, you can avoid the ones if you don't like to trade earnings, and get a sense for what symbols you want to take a look at. But right now, liquidity is slowly improving. I expect this list to grow today. This was updated yesterday around 3 p.m. I expect the number of symbols that are liquid to grow, which means that there are more opportunities for you to pick individual stocks as opposed to trying to trade ETFs right now. So things are certainly looking positive, but again, I want to warn people that 1 or 2 days do not make a trend. The key level to keep an eye out for is 273. Looks like we're just opening up right around 273. So I'm curious to see how the markets react to that level. If we're able to break above it, or if we struggle at 273. The overnight, futures seems to, every single time we hit 273, seems to bounce off of it. So let's see how markets react to this today. If we break above 273, I would say that's very optimistic. I would be even a little concerned that we move too far above 273, because then I would say that maybe markets are getting a little too optimistic, because the data currently is not particularly great on corporate earnings going into Q1 of earnings. So with that, that's what I wanted to talk to you guys here today. Looks like I have a couple of questions here. Raju is asking, what do you think about Microsoft? I bought at 158. Will it go up? Well, first of all, Raju, just to explain, I'm not here to predict where I think stocks are going to go. I'm here to show you research as far as what we see. Microsoft certainly in the cloud space is, I would say, more insulated than most other most other firms. So if we look at Amazon Web Services, that has actually been performing quite well during the sell-off. I expect Amazon, which has consistently been one of the strongest stocks in this particular market, will actually do fairly well, partially because of since we've been locked down for will likely be locked down for at least about 2 months and working from home for those of us that are lucky enough to be gainfully employed during this time. Microsoft is one of the stocks that will benefit from people working from home. And I think after the result of this, you're going to see a bigger shift in people working from home. So this is really something that we expect a relatively strong stock in the market. For those of you that are interested in a liquidity list, you can go to trade.optionsplay.com/liquidity, which I just posted into the chat window. As a creator of Options Play, what settings would you choose for cover calls until the end of the year? So I would say right now, I would definitely choose short-term aggressive for any cover calls. So for those of you that are using our platform for selling cover calls, you can choose your own settings. I would certainly choose short-term for any to take advantage of the high volatility, and conservative for my cover calls. And any comments on Costco? So Costco, also one of the stronger stocks. I will say that I don't think Costco will do as well as some of the other names, simply because Costco predominantly makes most of their revenue, 85% of their revenue, from memberships. They don't actually make a lot of money or revenue from the cost of goods sold. So as the consumer market buys a lot more goods in the next over the last couple of weeks to stock up, Costco is actually not as strong as some of the other names like Kroger, because again, Costco predominantly makes their money on the membership. So even if you buy more, they're not necessarily making a whole lot more on that, by the fact that you're making that. So I like Kroger's a little bit more than Costco. So with that, thank you so much for taking the time out here this afternoon, this morning. I hope that you guys have found this useful in helping you better set up your day, better set up what ideas to take a look at, and making sure that you have the liquidity list to know what's coming, what symbols you can focus on. So thank you so much. I hope you guys have a great trading day, and I'll see you guys next week.